podcast where I'm going to be looking at acquisition accounts as part of mergers and acquisitions, and this is predominantly aimed at my A2 accounting students. Okay, what is an acquisition account? Well, you do an acquisition and it can mean two different things, and both are acceptable under the exam board that I teach. So here we've got a copy of some work I've already done on a video where we looked at changing a statement of financial position for a company that I've made up called XYZ Limited, and they've purchased a business with the following assets and liabilities, and the purchase was funded by the issue of 300,000 $1 shares at a premium of $1 each, and also 18,000 in cash. And the first option a company has got is to, for each thing that they put into their account, so for example the assets, the liabilities, or the capital, just to do a simple double entry system where, for example, with the non-current assets here, we can see we debited the non-current assets and therefore they put a credit entry into the acquisition account. And what is more likely in an exam is you'll be doing this for a number of non-current assets. So inventory, debit the inventory account, credit the acquisition account, cash, debit cash, credit the acquisition account, goodwill, debit goodwill, credit the acquisition account, and with the liabilities, we would credit the liabilities and we would debit the acquisition account. And then just looking across here at what we do with the purchase consideration, the ordinary share capital in XYZ, because it's acquiring the company and issuing shares to do it, needs to be credited for 300,000, and therefore we would put a debit entry in the acquisitions account. We would credit the share premium for the 300,000 shares for the $1 or £1 premium per share, and therefore debit the acquisition account. And for the cash part of the purchase, we would credit cash and debit the acquisition account. And the reason a company would choose to do this is, in reality, there will be lots of non-current assets that the company needs to include in its accounts, and it's quite a complicated process, and therefore it's simplifying the transactions and just breaking them down into the individual components. But when we now look at the acquisition account, we can see that things are on the opposite side to where we would expect. So, for example, the non-current assets are on the credit side, the liabilities are on the debit side, and that's because if we look back here at the at what we've done, we've debited the non-current assets and credited the acquisitions, or credited the liabilities and debited the acquisitions. Okay, but what we can also see, and the reason why we do an acquisition account, because in reality these are quite complex, what we would expect to see at the end of the process is for the acquisition accounts to balance. If they don't balance, there's obviously being something gone awry within the accounting process. Now, the alternative way to do this is to keep the acquisition account outside of the double entry process in the same way that we do with a sales ledger or purchase ledger control account. And if we were to do that, the journal entries in the books would not include any reference to the acquisition account. So here we've got the debit entry for the non-current assets in, but no record on the credit side of that transaction for the acquisition. And we've got all the assets down here on the debit side. We've got the liabilities and the capital and the loss of cash as part of the purchase consideration on the credit side. And what we can see, and I've put it in here as red because it's not part of the journal entries, but we can see that the debit entries and the credit entries have still got to be equal. And that's only logical because if you think back to the acquisition account, we know that that has got to balance at the end of the time period. And also, the whole thing is a giant double entry exercise. We know what the purchase price is, we know what the goodwill is, and we know all the other information, but it's all got to overall be equal. Overall, the net assets that we purchase have got to be the same as the capital issued or the loss in assets by the firm to purchase this new company. And therefore, if we look at the acquisition account, okay, well, there's something here that we can notice. We can notice this time, if we're doing it as a control account, the debit entries are for all the assets, the credit entries are for the liabilities, the shares issued, and the cash. But the actual numbers are exactly the same. So it still balances at 718,000. It's just the mirror image of the acquisition account if it is done as part of the double entry system, okay, and there's no difference in the final balancing figure. Now, for the exam board I teach, they're quite explicit. You can do this account either way. Okay, it's an account really that's there to check that what is a quite complex procedure when you're looking at multinational companies acquiring other multinational companies is checked to make sure that the entries have all been completed and the debits and the credits have been equal throughout the process. Right, my students will have some questions to have a go at. Thank you very much for your time. And if I teach you, please feel free to email me with any questions on the video. Bye-bye.